Hello, and welcome back to our Economic Update series. In this series, we'll leverage a variety of financial experts to help you better understand the impact of various economic, socioeconomic, and market factors. I'm Brad Scott, Vice President of Wealth Management at CommunityAmerica, and we're excited that you've joined us to learn a little more about the potential impact of the midterm elections and other market indicators that could impact your financial future. So today we're joined by Tom Duffy, a client portfolio manager with Clark Capital. Talent like Tom and managers like Clark Capital are examples of the kind of access that wealth management at CommunityAmerica brings to our members. Tom has 20 plus years in the investment management business with companies like Merrill, BlackRock, and Clark Capital. He's a chartered financial analyst and a CFA charter holder. He's also a graduate of the Wharton Business School. So welcome, Tom. We're glad to have you.
Yeah, thank you, Brad, and good afternoon, everyone.
So before we begin, I wanted you to know that we'll have a Q&A session at the end of Tom's remarks. So please type your questions into the queue, and we'll address as many as possible in our time together today. So, Tom, I know that our members have been asking many of the same kinds of questions that your other clients are asking. So we thought this would be a good opportunity to answer some of those today, including what impact the midterm elections may have on the markets. So Tom, what can you share with us today?
Yeah, I mean, some of the things that we're being asked about, is the economy in a recession? Is inflation, has it peaked? When will the Fed stop raising interest rates? Are we approaching some sort of bottom in the market? Should I stay invested in stocks? Should I stay invested, in bonds? And yes, we are getting questions about the midterm. So I do have some slides and I can kind of walk through, what our best thinking is on each of those topics. What we're going to cover today, why are bonds down? Should I still own them? Do I need to worry about inflation? We know the Fed is raising interest rates. Is that going to cause a recession? Are we in a housing bubble? Are we going to experience something like we saw in 2007, 2008? Will that occur again? Have we finally put in a bottom here? Has the correction ended? And also, what about international stocks? Is that a good time or not to be invested in, internationally? And of course, the midterms again. And what are we doing in terms of managers navigating through this really challenging market environment? So let's first start, with bonds and kind of interest rates. So this chart here, this isn't showing the level of the 10-year Treasury. This is showing the change in the yield, the percent change year over year. And this chart goes back to 1962. So you could see that, going into 2000, we saw the biggest decline in 10-year Treasuries, again, since the early 60s. And now that big spike that you see over on the right-hand side, that's the increase in 10-year Treasury yields this year. So we've seen the biggest percent increase in 10-year Treasury yields, again, at least as far back as this chart, goes. So what does this mean in terms of an opportunity out there? So this chart is showing you what the effective yield is for different kinds of corporate bonds. So the red line are AA rated bonds. These are very high investment grade ratings. We would have companies like Apple, Amazon, Alphabet, Walmart, Berkshire Hathaway, Exxon and Chevron, Nike, Visa, Procter and Gamble. Those are companies that have that AA rating. So, that red line last year, it was below 2%. It was very, very low. We were in a zero interest rate environment. But now you look at the yields on those particular types of bonds, and they're now, above 5% in many cases. And then the other line, these are a little bit lower quality bonds, BB. They are below investment grade. So what's interesting is last year, the riskier bonds were yielding about 3%. Now, the ones with less credit risk are yielding 5%. And if you still want to have a little bit of credit risk, now you're really being compensated for it. We're getting yields that are nearly 8%. So the landscape has changed quite a bit for bond investing. We're looking at yields here that we haven't seen, in literally, decades in terms of the yield of maturity, current yield, and again, looking at some of the higher rated companies that are now giving these, very attractive yields. This, chart here is just basically walking you through an illustration of buying a bond and buying a bond at a premium. And this kind of applies to if you already own bonds. So if your bonds are down in value, if you've owned them for a year, if you own them for 2 years, 5 years, and they're not at maturity yet, they're probably down because interest rates are up as dramatically as they are this year. But what this example walks you through is if you buy a bond at a premium and say that bond is 110, it's going to mature at 100. So you're going to actually lose value if you hold it from the time of purchase to the time of maturity. Now, you might be asking yourself, what right now, why would I buy something for $11,000 and hold it for 10 years and I get back 10,000, I lose $1,000? Because in this example, you were being paid $400 a year in income, and that amounts to $4,000. So you make $3,000 total return. You lose $1,000 with principal, but you make $4,000 in income. Now, we show here that bond values don't have the straight line depreciation. They don't lose 1 point a year. It doesn't go from 109 to 108 to 107 in that kind of fashion. The value of the bond can go up, it can go down, it can fluctuate depending upon what interest rates are doing, and they're going higher this year. So what normally would take several years to see the value get close to the maturing par value, it's happened all at once this year. And that's kind of what we're seeing with bonds trading down in value. Now, what hasn't changed with the bonds that you own is they still are paying you the same amount of income. And that's why you want to own bonds. So this next chart shows you that if you go back to the inception of the index for bonds, and that goes back to the early 70s, the aggregate bond index, that 90% of the return that you got came from income and reinvesting the income. It didn't come because the bonds went up in value. It's not like the stock market where you buy a stock and you buy it at a low price and you hold it for 5 years or 10 years or 20 years and it goes up a lot in value. Bonds, again, you buy them, you hold them, you get your money back at maturity, and you're getting your income. And that's where the returns are coming from. And now that income is higher than it has been in many years. And then this chart here is just showing you this year how dramatically yields have increased. So that blue line on the bottom, that is where the yield curve was in the beginning of January. So this is 1 month going all the way out to 30 years. And you can see that, the front end of that yield curve was yielding less than 0.5%. The middle of the yield curve was yielding, let's say, about 1.5%. And the long end, like 20-year, 30-year treasury bonds, were yielding about 2%. Now, the red line is where those yields were at the end of September. And you can see that a lot of these yields are around 4%. And they've gone even higher since we put this chart together just in the last couple of weeks. And you can see that the size of those arrows is showing you that the front end of the yield curve went up a lot more than the back end because the Fed is raising interest rates. They're taking interest rates from 0 and they're probably going above 4%. They're at about 3% right now. So that, again, why is this important? Because our approach to managing bonds is not simply to ladder everything. We don't buy one bond for every year for 10 years or 15 years, and then one matures, kind of put it on the back end of that ladder. We're going to actively manage based on an outlook for directions of yields, because the entire yield curve doesn't necessarily move in the same magnitude or in the same amount. And that can create some opportunities to be positioned at different places on that yield curve. The next topic is inflation. And it's timely that we're doing this call today because we got another inflation number, the consumer price index. So we know that inflation has increased dramatically this year. I'm sure you're well aware when you fill up your car, you go to the grocery store, you go out to a restaurant, basically go anywhere, you're seeing higher prices. So this chart is showing you the blue line is the producer price index, PPI. Now, not too many people, follow that index. It's more for producers, manufacturers, what their costs are. But it is important because those costs get passed on to all of us. And that's the red line. That's the consumer price index. So what we have seen is that the producer price index appears to have peaked already this year and is coming down. Now you can see that with that blue line, it has peaked and it is coming down. Eventually it's going to go under that red line. And that's what you want to see, because the blue line is a leading indicator of inflation. These are producers, what they're paying right now. They're going to ultimately pass it on to consumers later. That's the red line. So if that blue line starts to go down first, the red line is going to follow it. Now the red line, consumer price index, peaked about 9.1% in June, and now it's down to about 8.2. So it's going down, but it's not going down fast enough yet for the Fed to say mission accomplished, and we don't need to raise interest rates anymore. But based on how that producer price index has been declining more rapidly, we would expect that you will start to see that in the consumer price index. And then this chart here is showing you the rate of change of inflation on a month-to-month basis. The prior chart was year over year. This is month-to-month. And at the right hand of this chart, you can see that while prices are still going up month-to-month, they're not going up as dramatically as they were. We were looking at earlier this year, month-to-month increases of 1%, 1.5%, per month. Now you analyze that, and that's how you get to a 9%, inflation for consumer price index, and we were up to about 12% for producer price, inflation. But the more recent reports that we have seen is 0 month-to-month, 0.1%, 0.2%. So the rate of increase that we're seeing month-to-month has decelerated quite a bit. And then I put this chart in here, surprise, surprise, people don't like to pay higher prices for gas. So what we've done here is we've taken the average price of a change, year-over-year change in gasoline, not the value of gasoline or the cost of gasoline, but how much did it change from year to year? Did it go up a lot? Did it go down a lot? And then the red line is consumer sentiment by the University of Michigan. How do people feel about things? And the higher that number, the better they feel about things. The lower that number, the worse they feel about things. So you could see, in the late 70s and 80s, we had a very big spike in gasoline prices, and we had a very big drop in consumer, confidence and consumer sentiment. And then it happened in the early 90s, big spike up in gasoline prices, big drop in consumer sentiment. And look at it now. Like, we've seen a dramatic increase in gasoline prices and a dramatic drop in consumer sentiment. This consumer sentiment is about as low as it's been, at least for this chart, since the late 70s. Now, if you can kind of see this, a little hard to see, but we've seen gasoline prices have come down quite a bit, and we've actually seen consumer confidence starting to get better again. So this kind of inverse relationship is still, happening. And then why is this important? Because if consumers feel better, they're going to spend more. And if gas comes down, that's psychologically, going to make them feel better and get out and spend more. So it's important, that relationship, and that's something that we're tracking and monitoring. We look at inflation expectations. there's different ways to measure this. There's bonds out there that are treasury bonds that aren't adjusted for inflation. They're like regular treasury bonds. But then there's another type of treasury bond that's actually indexed for inflation. They're called TIPS, Treasury Inflation Protected Securities. And if you look at what a regular bond yields, a regular 5-year, regular 10-year, and you look at what a treasury inflation, 5-year bond or a 10-year bond, what that yields, and you subtract them, and that's going to kind of tell you what is priced in to the bond market for inflation. So you can see that that has peaked earlier this year. So what the bond market with these treasury inflation protected securities is telling us is that we're at peak inflation and we're starting to see inflation expectations come down for the future. And that's important because the Fed is very concerned. They don't want to see inflation start to get in people's heads that it's never going to go down, and it starts to influence their behavior. Now, this green line, I go back to the University of Michigan survey. So this is looking at, asking people, what do you think inflation is going to be next year? Do you think it's going to be 2%? Do you think it's going to be 5%? Do you think it's going to be 10%? And they're asking, a bunch of people, they do the survey. And what we've seen from that survey is that people think inflation is going to start to come down a little bit when we think about next year. And again, these are important things for the Federal Reserve. They look at actual inflation, reported inflation, but they also look at consumer expectations for inflation, and they look at what the bond market is telling them about inflation. This is just an example of, some prices are actually coming down. Used car prices are coming down. Used car prices at one point were up 60% year over year. We actually saw, some month-to-month declines in used car prices. And now we've actually seen a year-over-year decline in used car prices. And that's actually a fairly large component of the consumer price index, new cars, used cars. So that's going to help bring down some of the inflation numbers when we start to actually see things go down in price. We've seen other commodities go down, other kind of goods have come down in price. What hasn't come down, though, food is still an issue. Rents are still an issue. Some of those components are still, increasing, but we are now starting to see other components within inflation are actually decreasing. This next chart, I call this CPI choose your own adventure. It's because, it's like those storybooks that you could choose your own adventure. But what this is showing you is different paths of inflation. So what happens if inflation on a month-to-month basis declines by 0.1%? What if it doesn't change at all? Prices just stay exactly the same. What if prices keep going up every month? 0.1%, 0.2%, 0.3%, 0.4%. So let's take the worst case scenario on this graphic here. Prices don't go down. Prices don't stay the same. Prices go up 0.4% every month from here on out. We will actually get to 4% headline inflation by June of next year with price increases. Now, how is that possible? Because we were going up by 1%, 1.5% every month. So we don't need to go down in price. We don't need to see negative prices for inflation to be less than it was, to go from 9 to 8 to 7, 6 to 5 to 4. We just need smaller increases in month to month. Maybe we get a couple of negative months. That would help. But it's happening now. As I mentioned, the last couple of inflation reports have been flat. They've been up 0.1%. They've been up 0.2%. And as long as that continues, you go to 0.2%, you get to 4%, in February. You get 1/10 increase, you get below 4% in March. So there is actually a path to get to lower inflation. And this chart on the right illustrates that as well. And then, what about investing during inflationary environments? What works, what doesn't work? So this period here is 1973 to 1981. and what kinds of stocks did well and what kinds of stocks didn't do well. Well, the stocks that did the best were companies that pay dividends and grow their dividend, increase their dividend. And the companies that did the worst were companies that cut their dividend, or companies that didn't pay a dividend at all. And that's really important right now, because the kinds of stocks that are doing better in this environment, now we know everything is down, but the kind of stocks that are not down nearly as much as the S&P 500 or tech stocks or growth stocks or small cap stocks or any of those parts of the market, the kinds of stocks that have held up the best are the very large companies in the US that have really good balance sheets, that are not expensive, and have a history of increasing their dividend no matter what happens. And that's, we believe, we're now entering into an environment in which those sorts of companies are going to be able to do better. Those kind of companies, some of them are holding up very well, and they're not seeing consumers pull back. They're not seeing a decline in profits. They're able to pass price on. They're able to do that, maintain their margins, maintain their profitability. There's not a lot of them right now, but they are out there. And that's kind of where it comes into individual stock picking and investment management, to be able to find those sort of companies. Next topic is are we in a recession? First, what is a recession, and who determines if we're in a recession or not? So I'm showing on this chart, GDP, right? 2 quarters of negative GDP, there's your recession. We've been, taught that. We've heard it over and over again, and it's just reinforced. But in reality, there's an organization called the National Bureau of Economic Research. They're the ones that look at all the data. They're the ones that are going to tell us if we're in a recession or not. And if you go on their website and you look at their, frequently asked questions, and you look and you say, what is a recession? What do they look at? They actually look at GDP and GDI. Now, what is GDI? GDI is gross domestic income. So theoretically, the two should equal each other, because the gross domestic product, that's the sum of everything that's produced in the country, and gross domestic income is the income that's derived from the production of all of those things. So they should, the ledger, should kind of equal each other, and they usually do. And you could see here when we were in a recession, during March of 2020, they're all kind of the same, at least directionally, they're the same. But what has been interesting, this year, and I had to blow this up so we could really take a good look at this. So we know that there's been 2 negative quarters of GDP, and everybody's running around saying there's your recession, there it is. But GDI has been positive the first 2 quarters, and now they average them. So we put that together. This purple is the average of GDP and GDI. Now it is negative, but it's barely negative. Certainly, it's not like what they would need to see for a recession. You need to see a deep, protracted, kind of downturn in the economy. This barely being negative, you can see it better here. You can't even see it. It's so small that it's negative. And then the other thing is that this isn't the only thing that the National Bureau of Economic Research looks at. It's not as simple as just saying GDP and there's your recession. They look at a lot of other factors. So they actually list 6 specific things on their website. They look at, jobs numbers. They look at personal consumption. They look at, income. They look at industrial production. They look at manufacturing. These are the things they look at. So the first half of this year, the first 2 quarters, 5 of the 6 were positive. The only one that's been negative is manufacturing. And even now, July and August, we're still seeing these be positive, again, with the exception of manufacturing. So we're going to say that we're not in a recession in the first half of this year. We're going to say we're not in a recession today, but we will also say there's a possibility we could be in a recession, maybe at some point next year. But the jury is still out on that, because while we are seeing at least manufacturing, start to look like it's experiencing a contraction, we still have a 3.5% unemployment rate. We still have 10 million job openings. People are still seeing their wages rise. We're still seeing spending. People are still spending. So, we're not convinced that we're going to go into a recession, but we're watching things. We're watching these data points. And if we go into a recession, we wouldn't think it would be, anything that would be severe, more of a mild, sort of, technical kind of variety of a recession that wouldn't last very long. So, again, this is really what we're more focused on, the data points that the NBR actually looks at. And then this chart, this is actually put out by the Philadelphia Fed. And they have a heat map for all the different states. So what does it look like when you're in a recession or you're about to go into a recession? Well, you see a lot of red, across the country. So this was March of 2020. And if you saw April, every state was red. Now that was kind of an unprecedented, we shut down the whole economy. But, going into a recession, you're going to see maybe not all 50 states be red, but you're going to see a lot of red, on this map. And we're not seeing it. Right now, we got Montana and West Virginia experiencing slight contraction. But we got every place else, California, Texas, New York, Florida, Pennsylvania. They're all, still seeing expansion in their state economies, and that, is the national economy. So we watch this too. And then, we know the Fed is raising interest rates. What does this all mean? It's a real headwind. I mean, there's no question that why are stocks down? Why are bonds down? Because the Fed is raising interest rates. And why are they doing it? Because we had 9% inflation. And that's what they're doing to try to bring down demand and try to bring down prices. So how does the market react to all of this? Well, at least initially, it doesn't react very well. When the Fed starts the rate increase cycle, the market goes down. So these are like the last, 3 or 4 rate increase cycles going into, the 90s, 2000, and then, 2015 to 2018. So initially you get, the market down, could be down double digits. But the thing though is that, it typically bottoms before the Fed stops raising interest rates. And it kind of bottoms out, and then it actually starts to do okay. When you look at the full rate cycle, from the time they start to the time they stop, tends to be positive returns. So when is the Fed going to stop raising interest rates? Well, it's not going to be this year. They're going to raise next month. They're going to raise in December, and they probably will raise. The first meeting next year is in February. So, between now and then, we would probably be putting in some kind of bottom in this market. Now, I don't know if today was the bottom or tomorrow will be the bottom or next week. We don't know that. But we know from history that we would expect that the bottom will come sometime before the Fed is done raising interest rates, which right now is expected to be, early next year. So you don't want to wait till the Fed, is done raising interest rates and they tell you that, because the market will already, be higher, because the market's going to figure that out. The market's going to read between the lines and try to, guess when they're going to do it. Now, the market was wrong, in July, because they thought the Fed would stop raising interest rates before the end of this year. We had a big rally in July and in early August, and then Jerome Powell came out in the Jackson Hole, Wyoming, and he told us, no, we're not done raising interest rates. We're going to keep going, and we're going to go higher, and we're going to be higher for longer, and we're going to do that. And the market went right back down, and here we are today. But eventually, the market, the Fed is going to stop raising interest rates, probably somewhere around 4.5%, and they're going to keep them there. But that's okay. They just need to stop, right? They just stop raising interest rates, and that's going to be a real catalyst for the markets to turn around. And then it's also true with bonds too. Bonds saw a similar sort of reaction. They go down when the Fed starts raising interest rates. They kind of bottom out before the Fed is done raising interest rates, and then through the whole cycle of the Fed raising interest rates and then stopping raising interest rates, they do okay. Now, stocks and bonds do better when the Fed is cutting interest rates, but I don't think we could be talking about cutting interest rates yet because they're not finished raising them. But that day will come too. They don't want to keep interest rates at a restrictive level of 4.5% forever. Their idea of neutral for interest rates is about 2.5%. So eventually they'll go back to 2.5%, and that's going to be a really good environment in which to own stocks and bonds. And that could come early as late next year. If that inflation, those numbers come down, the Fed has no reason to keep interest rates high. They will restore them back to a neutral level. So again, it's all dependent upon inflation. And then, we're looking at prior bear markets, recessions. What if we are in a recession? Well, the market kind of figures it out. The market starts to go down about 5.5 months before the recession begins. And then the market, tends to bottom out and tends to start to trade higher before the recession ends, about 3.5 months before the recession is over. So again, it's not something where you want to wait until somebody comes out and says the recession is officially ended. By the time they do that, the market's going to be, up, a lot potentially. So you look at March of 2020. We obviously were in a recession then, but when did they tell us the recession started? When did they tell us the recession ended? It wasn't until much later that year. So if you kind of just hung around and waited for them to tell you there wasn't a recession anymore, you missed out on a really strong recovery in the market. So we think, again, whether we're in a recession or not, we don't know. But if we do go into a recession, the market's going to trade down ahead of it. It's already down a lot now. I mean, it's down over 25%. And that's actually a little bit more than what you see during a period when there is a recession. So if you get no recession or you get a mild recession, that's better than what the market is priced in. The market being down about 25% is pricing in something more than a mild recession. And then, what is the Fed's job? What are they trying to do? They have two objectives. They want to have full employment and they want to have price stability. So how have they done with the first part of that mandate, full employment? That's the blue line. They've done a really great job because we have 3.5% unemployment. How have they done with price stability? Well, not so good. We have 9%, 8% inflation. That's the red line. So the Fed wants to get both of those, down. We already got employment down. I got to get inflation down. And, where we are with unemployment, we'll see a bit of an uptick, in the unemployment rate. Now we're at 3.5%. Maybe we go to 4, maybe go to 4.5, because wage inflation has been a real issue for the Fed. People being able to, feel like they can just quit their job and go get another one and get a 10, 15%, increase. That has, created a lot of job hopping, and that's kind of fueling that wage price kind of spiral. So, the Fed, is looking at that, and they are raising interest rates. We are hearing some, things about layoffs and hiring freezes. Hasn't shown in the numbers yet because we're still at 3.5% unemployment, but eventually it will work itself into the numbers. And maybe we get up to 4.5%. Now, we don't think we're going to 5, 6, higher than that in unemployment. We think, again, the Fed could get the objective of bringing down inflation, seeing a little bit of an uptick in unemployment, and get what they're describing as a soft landing for the economy. And then, what are some of the warning signs that you're about to go into a recession? So we look at the yields on treasuries and the relationship between 3-month treasury yields and 10-year treasury yields. And when 3-month treasury yields are higher than 10-year, that's called an inversion. Now, when have these inversions happened in the past? Well, they happened, before the recession in the early 90s. They happened before the recession in the early 2000s. They happened before the financial crisis. They even happened before the pandemic recession. But they haven't happened yet here in this environment. We are not inverted with the 3 and the 10 month. Now, we might become inverted at some point, but the inversion doesn't guarantee that you do have a recession. This chart, we were able to take this chart back further. There's been plenty of times where it's gotten inverted and it hasn't led to a recession. So it's not a done deal if it does invert. So we would pay attention to it, but we wouldn't put too much, into that. And then turning to the housing market, no, we don't think we're in a housing bubble. We don't think there's this imminent housing collapse that's about to happen. Although, we think the price appreciation over the last couple of years is unsustainable, and you're going to likely see prices come down a bit. And that will actually help with inflation. As far as the Fed is concerned, that will be a good thing because, home values, rents, these are the reasons why we have inflation as high as it is. That is a very big component of the inflation numbers, the shelter and rents. And we haven't seen them come down too much yet. And that's why we still have these high inflation numbers. But at some point with 7% mortgages, you're likely going to see that. But when we think about, who has all these mortgages? So this chart is showing you, these are the bottom 50% of wealth in this country. And those people have about 23% of the mortgages. So the inverse of that is the top 50% of people who have the wealth, that 77%, they have 77% of the mortgages. And then we look at, existing mortgages. I know buying a new home right now with home values and, mortgage rates, payments are high. But what about everybody else that already owns a home with a mortgage? A lot of people have locked in yields that are, below 3%. So it's not really that much of a stretch. And also they locked in lower home purchase prices. So it's not that much of a stretch for people who already own a home. When we look at the percent of their mortgage payment relative to their disposable income, it's somewhere below 4%. It's not a really high number. And then, alluded to this earlier, we have seen a decline in home prices. We went on a stretch here for, a little over 10 years of consecutive monthly increases in home prices for 10 years in a row. We saw the first month decline. That wasn't a big decline, it was less than 1%, but it's a decline. So again, our expectation is you're going to see some softness in home prices, but we still think there's some structural things going on why, there's demand for homes. So this chart here kind of speaks to that. So these are new home sales. The blue bar here, these are the number of homes that are being sold each month. The red bar is the inventory, the number of new homes that are available to be purchased. Now, a lot of people are not buying from homes that are, unsold new homes. They already are under contract for that specific home and it gets built for them. But this is showing you that there's more demand for how new homes than there is supply. Now, look, the demand has come down a little bit and the supply is going up a little bit, but it's still an imbalance of more demand and less supply. Now, these are new homes. These are existing homes. This is much tighter. This is showing you how many existing homes are being sold each month relative to the inventory of existing homes on the market. Now, there's a much bigger difference there. One of the things that we're starting to see is people are very reluctant to move because they locked in that, sub 3% mortgage rate. So if you're thinking, well, I have a 3-bedroom house or a 4-bedroom house, and I just want to move across town, and I want a 5-bedroom, 6-bedroom, whatever it is. I want a bigger home. Maybe you're not going to sell your house right now because you're going to have a 7% mortgage on that new house, and you probably like your 2.99% mortgage on your existing home. So the higher mortgage rates have actually created less supply of existing homes because people don't want to sell them unless they absolutely have to. And then, correction, is it over? Again, we don't know. We're not going to come out and tell you, today, this morning, was the bottom, or next week. But what we do know is that these kind of downturns in the market tend to occur fairly frequently. 5% declines, they tend to happen about 3 or 4 times a year. 10% declines happen about every year. 15% declines happen about every 2 years. 20% declines happen about every 3 years. So the last time we saw a big decline was March of 2020. We didn't see any kind of decline last year. We had 70 record highs on the S&P 500. We had maybe a 3 or a 4%. I think we had 5%, drawdown, but those, they didn't last very long because they would go to a new high, within days. So the last year was not normal. It's not normal to not have, a 5 or 10% pull down in the course of the calendar year. What we're experiencing now is actually a little bit more normal, that the market, goes on these long runs and then it experiences, a downturn, and then it goes back higher. Again, this is showing you just another way of looking at this. Since 1962 to last year, these aren't the annual returns of the market. These are the big drawdown that happened in the middle of the year. So we've seen this before. We've seen some very big drawdowns in the market, but we know the market has gone higher since 1962. So, what we're experiencing, we've seen this very often, in the market where you see these temporary, big downturns. And then, the market going down is good if you're putting new money in. I mean, because you're buying at lower valuations, lower price to earnings multiples. The lower your price to earning multiple when you're buying stocks, the more likely you're going to make money. If you're buying stocks when PE ratios are 25, that's really not a great time to be buying because stocks are very expensive. If you're buying stocks when the PE ratio of the market is 15, like it is today, that's a good time to be putting money into the market. It increases the probability that you're going to have positive returns. Another thing we look at is, how do people feel about the market? Are they bullish? Are they neutral? Are they bearish? Now, this survey here, this is from the American Association of Individual Investors. This survey has been around since 1987. This is through the month of September on a weekly basis. We saw 2 consecutive readings where more than 60% of the respondents to the survey think the market is going to continue to go lower for the next 6 months. They're bears. They're bearish on the market. And we've only seen about 20 or less than 20% of people that think the market's going to go higher 6 months from now. Now, in the history of the survey, there has never been 2 consecutive weeks where over 60% of the people think the market's going to go down. When we've seen similar readings on this survey, when they've been? March of 2020, during the financial crisis, after the dot-com bubble and 9/11, and probably when the survey started in 1987, October of 1987. That's when you see a lot of red, a lot of bearish sentiment. But every one of those prior periods when you've seen this much red on this chart, that has been a buying opportunity. If you saw 60% green, that is not a buying opportunity. You probably saw that in March of 2000 at the height of the dot-com bubble, when 70% of these respondents to the survey thought the market was going to go higher forever. So you do the opposite of this survey, and it's best summarized by what Warren Buffett is famous for saying: be fearful when others are greedy, you be greedy when others are fearful. And he also says you buy when there's blood on the streets. Well, this looks, this red, that's what that looks like. And then this is a little bit of a non-scientific indicator, but when you start to see CNBC run markets in turmoil, and they got the bear on the screen and the red arrows, and it's all of that kind of stuff, that tends to be around the time the market bottoms as well. So there actually was a research put out around this. We kind of joke about it, but there was actually some science to it. So somebody, on the internet, of course, they did the research. They went back and said, well, how many times did the CNBC run this nightly special, Markets in Turmoil? Well, going back to about 2010, they've run the special over 100 times. And this person put this together in a spreadsheet. You have the dates and what the market did a year later. And 100% of the time, a year later, when they run this particular special at night, the market's been higher, 100% of the time. And the average return has been 40%. Now, look, I can't guarantee you that it's going to be higher a year from now or you're going to have any specific return, but I like those odds. So, again, a lot of things are coming together for us to say, we may be putting in some kind of bottom, in the market soon here in terms of what we've seen recently. And then this is just showing earnings. Okay, stock earnings. Stock should be valued on earnings. Stock should not be valued on what the next CPI number is, or what the Fed is going to do next, or any of that. But that's how the market's trading right now. It's trading off of inflation. It's trading off the Fed in the near term. But over the long run, the market's going to trade off of earnings. And earnings are still expected to be higher this year and higher next year. Now, they're not going to be up 10, 15%, right? But there might be up, let's say mid to high single digits. So there's a disconnect here. Normally when stocks go down, it's because earnings have gone down. And we've seen that in 2000. We saw it during the financial crisis. We saw it in March of 2020. But what we're seeing now is only stocks are going down. Prices of stocks are going down, but earnings are still going higher. So that doesn't make a lot of sense. We think that the earnings are okay, and the stocks should not be down as much as they are. And maybe we'll get back to an equilibrium where the market figures that out. But it's really case by case. That's where the stock picking comes in, and we're looking at the companies that we think can do okay in this kind of environment and maintain their profits. International stocks, right now international has been beaten down pretty sharply. I don't think we need to go into why that is on this call. I think everybody knows what's going on, but it may create some opportunities there. So international markets are down 30+%, but they have become very inexpensive valuations. 10, 11 times earnings. And you don't want to exclude international from your portfolio, because some of the best companies in the world are domiciled outside of the United States. So to kind of restrict yourself just to the U.S., looking at some of the larger components of international, companies like Nestle, Samsung, Louis Vuitton, Toyota, Unilever, BP, Sony, L'Oreal, SAP, Siemens. I mean, these are very big, companies that are outside the United States. So and they're very inexpensive right now, given that, we've seen the performance be down more than the United States. So that might be setting up as some opportunity. Now, it may not pan out immediately because we know there's some challenges, internationally, but eventually they're not going to have the issues they're experiencing right now. And then midterm. So it's midterm time. So we've looked at this and we've gone back, to 1900. So over 100 years of presidential cycles, the 4 years of the presidential cycle, and they created a composite, the average return of the S&P 500 in the various years within the presidential cycle. So the second year, which is the midterm year, which is the year in which we are in, has the lowest returns of the 4 years of the presidential cycle. It has the biggest drawdown of the 4 years as well. But the good news is that once you get close to the midterm or at the midterm or after the midterm, the market has done a lot better the following 2 years. So we're looking at this again and saying this is following the same pattern as it has in the past. So this is a very busy chart, but this shows you, this one goes back to 1934. And you can see there's been some big declines, 30%, 50%, 44%, 19%, 33%, 16%. At the time we put this together, we were down about 21%, in the market. But every time, 12 months later in a midterm year, the market has been higher and it's been significantly higher. Now, again, I can't guarantee you that 12 months from this midterm, the market's going to be positive. I can't guarantee you that it's going to do the average return of over 40%, like it's done in the past. But like I'll say, like just like the CNBC, markets in turmoil, I like these odds. And we think, there's a lot, it's just not the midterms. There's a lot of things happening. We expect inflation to be lower, the Fed not to be raising interest rates, and growth to resume in the economy next year. So that's really why we think stocks are higher. It's not simply because it's done it in the past, in midterm cycles. And then what are we doing as an active manager? We've moved a lot of our strategies to cash equivalents. There used to be a saying that cash is trash because it yielded nothing. It had zero yield. Now cash is, 3-4%. It's just not a place to hide out. You're actually making some money there. So some of our strategies, did not like what they were seeing in the market at the end of August, and they just got out. We have bond portfolios that went to cash. We have some stock portfolios that went to cash, and they're still in cash equivalents today. So they missed a big drawdown in September. They're missing what's happening in this month, and then they're ready to go back in at some point and redeploy that. Now, not every one of our portfolios can do that. Some of them do that. Other portfolios are going to stay invested. If they're a stock portfolio, they're going to stay in stocks. If they're a bond portfolio, they're going to stay invested in bonds. But there's some levers that we can pull within the portfolios. We're tending to favor the very defensive companies that we think can hold up better in this sort of environment, like consumer staples. Think about the things you buy at the grocery store, healthcare, utilities, telecommunication, energy, avoiding some of the more cyclical types of parts of the market, technology, consumer discretionary, industrials. So we're playing a little bit of defense. We want quality companies, good balance sheets, paying dividends. We don't want over-levered companies that have a lot of debt. That's kind of what we're doing right now. And we're getting some very good rates on our bonds right now. As I mentioned before, AA rated bonds yielding over 5%. Some of the best companies in America are on that list of AA rated companies. And we're also doing some tax management of client portfolios. If we have losses, we're taking those losses and we're reinvesting in something else for 30 days. And then we're going back and unwinding that. So we're harvesting losses wherever we can to make sure that our clients don't have surprises when it comes to tax time, for this year. And, we are already starting to see some reports of some mutual fund companies that while the mutual fund might be down 10 or 15 or 20%, they're actually going to pay a capital gain distribution in November or December. So you might be asking yourself, if I have a mutual fund that's down 15 or 20%, I didn't make any money this year. Why am I going to have a capital gain? Because they may have bought those stocks last year, 2 years ago, 5 years ago, 10 years ago. And so many people have pulled money out of mutual funds. It's forcing the managers of the mutual funds to have to sell to meet those redemptions. And the people that don't sell, that are still holding the fund, they're going to be paying the taxes for the people that got out. Now, what we do is more on an individual basis with individual stocks that our clients own directly. So they're not impacted by what other clients do. Another client liquidates their entire portfolio, that's not going to create a tax burden for our other clients because they all have their own holdings, individual cost bases, and we can do tax loss harvesting.
Hey, Tom.
So I'm kind of running close to time here. So I'm going to kick it back to you, Brad, if we do have any questions. I'm able to stay on the line a little bit longer to take them if we can do that.
Yeah, thank you very much, Tom. Covered a lot of territory in the last hour, so I appreciate you sharing that with us. What I took away, thank you very much for this, is some hope, right? We may not be out of the woods yet, but there's a lot of indicators lining up to give us hope for better returns in the future. So thanks for sharing that with us. You must have covered it incredibly well. We have no questions in the queue. So I'll finish by thanking Tom for taking the time with us and all the talent that it took to build the presentation. So thank you for that. And for everyone else, thank you for joining us today. We'll follow up with a recording of this webinar, and also we'll post it to our website. So please feel free to share this with anyone whom you feel may have interest in our topic today. If you have questions and would like to speak to one of our advisors, please reach out to myself or any Community America employee, and they'll get you connected to an advisor who can expand on this conversation. Likewise, if you already have an advisor, please connect with them for a deeper dive. But thank you very much for taking the time with us today, and we hope to see you the next time we do this. Take care.